Great. Good afternoon. Thank you very much for joining us today. My name's Mark Norris. I'm a partner in the London office, and I'm joined by Daniela Barrdear, who is of counsel in our London office. Daniela recently joined Sullivan & Worcester from Hogan Lovells, where she was for 12 years. Daniela and I worked very closely actually in the past on opposite sides of the table, so it's very nice to have you here. And well, welcome.
Thank you.
and your first webinar.
Yeah.
So in the past we've worked quite closely on export credit agency work, but I know you've got a particular focus on DFI work, and we thought it would be useful for this this webinar to look at DFIs in the context of credit risk mitigation. And so by way of an overview, we're going to look at actually what DFIs do, and touch on how they differ from ECAs, and then Daniela, you're going to get more of a deep dive into DFIs from a credit risk perspective.
Yeah, exactly. We're going to look at the benefits that banks are getting in obtaining guarantees for the purpose of credit risk mitigation. We're going to look at the eligibility requirements that are specified in the CRR and how those are met by these types of guarantees. And then we'll also look at what is in the horizon, which with CRD 6.
Yes, so just to wrap up, just to have a look at a change that's going to happen in Europe, which could actually have quite a big impact on lenders in the export credit agency space.
Yeah, exactly. So now, as Mark said, we wanted to talk a little bit as to what DFIs are, what ECAs are, put things in context, and also why banks are looking to these institutions to provide these guarantees.
Certainly what I see is that DFIs, well, export credit agencies have become very active.
Yeah.
And certainly they're active very much from a national interest perspective. Yeah. But the DFIs are also becoming increasingly active, and I see that they're looking to work with export credit agencies
quite a lot. Yes. And I mean, these DFIs are specialized institutions. They're specialized development banks, and they're set up to support private sector development in developing countries, in emerging markets. Whereas export credit agencies not do the opposite, but
well, yes. I mean, they've got much more of a national interest, a national agenda. And certainly, I think one of the observations that has been made is that a lot of the ECA projects have actually benefited the global north rather than the global south. And while a lot of those projects may be good for climate mitigation, they're not necessarily development-led.
Yeah, and they're there to support their exporters. Obviously.
Yeah, absolutely. So there's much more of a national interest.
Yeah.
Whereas my understanding is that the DFIs differ.
No, exactly. So the DFIs will have this development angle to their remit, but we clump them together, I guess, in the context of the guarantees that they provide to banks, and where banks are looking to reduce their regulatory capital. We see the rise of these guarantees, both from ECAs and DFIs, being used. And in our role, we start looking at issuing legal opinions, really, and analyzing the eligibility of these guarantees in that context, because these guarantees are just one of the many ways that banks can transfer the credit risk.
But actually, I suppose taking a step back, if it wasn't for the DFI, then probably it's unlikely that a bank would have actually be doing the transaction, whether it So, I mean, the capital relief is important, but it's also providing a guarantee in an environment where a bank would not be prepared to lend.
Yeah, that's exactly right.
So, I mean, there, I think that the phrase is additionality, so that DFIs are looking to crowd in the private sector.
Yeah.
And I suppose by doing that, and to make that financing attractive, they're providing those guarantees.
Yeah, I think that's very much so. So let's take a look at the context that we're talking about, and a little bit of a setting the scene, let's say. So to meet regulatory own funds obligations, banks need to calculate what is called this total exposure amount. And it's a sum of what their operational risk, the market risk, and risk of a credit valuation adjustment. And this calculation includes an additional calculation of a risk-weighted exposure amount. And I just wanted to touch on what this risk-weighted exposure amount is, because to put it simply, it's looking at the amount that the bank would lose if there were to be a total default. So the bank's exposure value is multiplied by the risk weighted allocation that is given to that underlying obligor. And this can come from credit ratings that are using standardized tables, but then also the own bank's assessment will create this rating that is allocated. Now, of course, we as lawyers don't get involved in these calculations at all. We simply look at the eligibility criteria once once this protection comes into play. But I think it's really important to look at why it is that the banks are considering these types of instruments.
Because, I mean, presumably for the majority of countries that DFIs are working in, the credit risk weighting exposure is going to be significant. It's going to be,
and it's not going to allow them to even offer any products within the country, because it's going to be too high of a cost to actually operate. So credit risk mitigation works in two forms. There's two forms of protection available. There's the funded and non-funded. Funded with where we're looking at the actual assets, the collateral, and unfunded is what we're looking at here. It's these guarantees. You don't actually only need guarantees. It can come from credit insurance or unfunded risk participations. But in essence, what these types of instruments allow the bank to do is to substitute the risk weight of that guarantor, whoever's providing this guarantee, and put that in place of the borrower. Obviously, so long as this credit protection actually meets the eligibility criteria. And that is really what we are looking to meet here, is ensuring that this unfunded credit protection meets the CRR requirements.
so this was actually the question I was going to ask, is
Yeah.
how do you, I mean, who are these DFIs, and how do you know you get any benefit from engaging with them?
I think that's exactly it. So the benefit of these DFIs and these multilateral agencies, export credit agencies as well, is that a number of them are actually named in the legislation. So Article 117, 118, I think it's 204 off the top of my head, for ECAs actually names these entities, and they are known, well, they are given a zero risk weight. So the fact that these entities are named in the legislation and give you this zero risk weight, it can be really beneficial for the banks in calculating its own risk weighted exposure amount. And I put here a couple of examples because I think it's really evident once you look at this, but let's say that we have an A-rated guarantor. As usual, a corporate guarantor that might be guaranteeing its subsidiary who is BBB rated. The own funds requirement of the bank is significant here for a loan of 10 million, for example. But with this loan, this guarantee that is provided by an A-rated guarantor, then that risk weight is substituted. So the own funds of that A-rated guarantor, so the own funds requirement on the bank is halved.
And just a quick question. So from a DFI's perspective, in terms of issuing the guarantee, it doesn't have to be a sovereign beneficiary. It can be a corporate.
That's exactly it, yeah. But here with a DFI guarantee, you still have a BBB rated corporate. And without any guarantee, the own funds requirements would be the same as before for the bank on that similar loan. But where you have a DFI guarantor, you can substitute. So for example, here, EIB is one of the named DFIs in the legislation. Then you can substitute their risk weight of 0, meaning that the own funds requirement for the bank is 0. So you get a much greater ability. The bank has a greater reduction in its capital requirements. It enables the bank to profitably reduce the pricing of the support that is given to the borrower.
And presumably extend the tenor.
Extend the tenor. And like
Well,
you said,
and also supposed to do the transaction in the first place.
exactly, just even enter that market. So there's quite a lot of benefit that comes from these guarantees. And it is, I think, why we are seeing them more and more being used. But of course, they are, just because you have a guarantee from one of these DFIs, one of these ECAs, it doesn't mean that you will automatically get the credit risk mitigation that you are looking for. Because of course, we then have to look at whether or not that guarantee is eligible.
Yeah.
So does it meet the eligibility requirements under the CRR? So here we look at, the 194, 201, the articles that we as lawyers are very familiar with, because we have to assess these when giving these reasoned legal opinions. When we go line by line, we look at the document itself and ensure that these are met.
And you're probably going to come to this, but when we talk about enforceability,
yeah,
it's enforceable against who? I mean, what is a DFI?
Well, that's what we're gonna really look at them. So let's look at the enforceability element. So this is the Article 194. So what we are looking for here is that the guarantee, the protection that is given, is actually legally effective and enforceable in all of the relevant jurisdictions that relate to that transaction. And then the bank is also required to obtain an independent, reasoned legal opinion, which is where we come in, that establishes that the credit protection meets the relevant criteria as set out in the legislation. So let's consider enforceability one at a time, because there's quite a bit of these. So in our opinions, you would usually see something like this, saying that the obligations are expressed to be assumed by the guarantor, so in this case, the DFI, under the guarantee agreement, and these would constitute effective enforceable obligations. But like you say,
well, and what does that mean?
who are these entities? Yeah, and what does this mean? So it would mean that you need to establish who is your counterpart, who is your DFI. And in order to do that, you have to look at the governing rules of these entities. And this is where these entities become special, and they are a bit more tricky to deal with, because no two DFIs are the same, no two ECAs are the same. And they have their own governing rules. These are institutions that are set up by treaties between multiple governments, by charter, royal charter, and also legislation that puts them in place. And it is often the case that there are multiple treaties that get re-signed over the years, or different amendments to certain legislation.
Yeah, but with the sovereign, it's easier because you're just for an export credit agency. I mean, if you're looking at UK export finance,
It's one government.
it's the crown. You can look at the legislation.
Yeah.
It's not a multilateral. And there's a whole procedure about how you enforce against a judgment against the crown, and that's
It's set out.
well established English law. I
Yeah.
mean, there isn't a treaty there. I mean, the UK export finance is party to the OECD consensus, but if you want to know what its powers are and how you enforce, you just look at the legislation.
Yeah. And it's exactly the same here. It's exactly the same here. It is, the only thing to keep in mind is that you may have obtained a guarantee from IFC, and the protections that are given, the immunity that is given to that entity are very different to your next DFI or EIB, for example. And so just because one entity is treated in one way and your proceedings, your legal proceedings, if you want to bring legal proceedings, are prescribed in one way, they will be very different from DFI to DFI. And it is really important to understand that for the bank. So if we look at, for example, the waiver of immunity language that is often included in a number of these guarantees, the waiver of immunity language actually doesn't waive any immunity. It is simply telling the reader that nothing in this agreement will actually serve for that guarantor to waive its privileges, to waive its immunities. And anytime any counterpart will look at this, this will raise eyebrows. And so it's important to look at then what is actually the protection that is given to that DFI. It might be in some situations, the immunity is only applicable to that entity's assets, for example, meaning that wherever they are located, those assets are safe from confiscation or expropriation. So it might mean that you cannot go and take possession of said assets or get a court order to put an injunction on these assets, but it doesn't mean that you cannot bring suit, you cannot bring legal proceedings.
So generally, immunity is not an issue with DFIs.
Not for the purposes of CRR, no. We are yet to see one where there has been an issue, because you then look at the, what the dispute process might be and what the governing rules actually say as to what the guarantor's personality is. And in all elements where these entities are going to enter into contracts, these entities have the full legal personality and capacity to enter into both the contracts, but then also be party to legal proceedings.
So will they have submitted to a jurisdiction?
And they may submit to a jurisdiction, but then also the relevant governing rules, like you said with ECAs, they will dictate what proceedings may be brought and where.
Yeah, but the thing with an ECA is, certainly with UK export finance, it is the government. So it's not, we don't have to worry about it being a multilateral, because it is the Crown, and there's a whole legislations there under the Crown Proceedings Act for how you enforce against.
Yes, definitely. But with others, for example, you might only have recourse to arbitration. And the arbitral body is already specified, so you have to take these two under the ICC proceedings, for example. But then In other situations, you might have specified Court of Justice of the European Union. EIB's protocol actually says that you may bring proceedings in any other jurisdiction. But if you were to enforce the judgment of those proceedings, that can only be done through an enforcement with an order from the Court of Justice of
But that's any other court in the EU.
from a member state.
Yeah, from a member state. Yeah.
Exactly. But that gives you greater, but I have seen certain guarantees from EIB, for example, where even though this ability to bring up proceedings in other courts, they do just limit it to any proceedings have to be brought on the Court of Justice of the European Union.
And is that straightforward?
Not a dispute litigator, sure.
Yeah. But from our perspective, from issuing a legal opinion.
From the perspective, yes, absolutely meets the requirements.
Yeah. Well, I suppose from a lawyer's perspective rather than an English lawyer's perspective, because it's a EU matter, but from an EU perspective, that's not a.
No, that's not an issue. So, the other thing I wanted to mention was, okay, the second element is who is this counterparty? And I think as we mentioned, a lot of these multilaterals and the DFIs are actually named in the legislation. And the Article 201, where it's looking at the counterparties from whom these protections can be issued, also names, the central governments, multilateral development banks, and international organizations. So very easy to tick this box, and that the DFIs, multilaterals, and ECA will fall within these categories. But this is where we wanted to touch on the ECA, what the ECAs are and how they are a little bit different, because just because they will fall into an eligible counterparty and be an eligible counterparty, it doesn't mean that they will get that zero risk weighting that we were talking about, that DFIs are granted under those other articles of the CRR. But also it is really important to then take a look at which ECA you are entering into.
Yes, I mean, in some respects, I think ECA, dealing with ECAs is probably more straightforward, because I mean, in the past where you had a company that was an ECA that may have had a sovereign guarantee, there were issues around whether that the guarantee from the ECA would be direct, because you had a company that had the benefit of a guarantee.
Yeah.
I mean, certainly when you look at UK export finance, it is the Crown. It is a ministerial department. The legislation's there, so there's the legislation that sets up UKEF and gives it its power, or the Export Credit Guarantee Department, as it's actually that's what it actually is, but it's known as UKEF. And then in terms of enforcing, you're enforcing against the Crown, and one would look at the Crown Proceedings Act. So you just have to apply public law principles. And when you look at issues about how, certainly as a matter of English law, how a civil servant can bind the minister, there's a Carltona principle. So a civil servant is the alter ego of a minister. So it's all when you look at an export credit agency, I suppose in many respects it's more straightforward, because you're just looking at one jurisdiction. When you look at US Exim Bank, they issue their own form of guarantee around the powers of US Exim. So it's not multilateral. You don't have to worry about other
jurisdictions and other credit ratings from other institutions, definitely. Okay. And I think like that is the main difference. We often look at ECAs, multilaterals, but these entities are very different.
Yes, and also the thing about, as we touched on at the start, an export credit agency typically acting from a national interest
Yeah.
rather than from a development interest.
And they are, although they all have that backing from central government, it is interesting when we look at specific ECAs. Some of them, for example, are structured, like you said, as part of government, like UKEF and USXM. But then you might also have some corporations that are state-owned or privately owned organizations that have the backing of the sovereign. And so with all of these different structures, you will have to carry out that analysis of, okay, what is the risk weight that is allocated to them? But as you say, the legislation will be in place. It will be clear from the governing rules of that ECA.
Well, certainly from an English law perspective, with UK export finance, you're applying general principles of public law, interpreting the statute.
And that makes it much more simple. So let's take a look at the other eligibility criteria that needs to be met. So here we're looking at the credit protection actually being direct, that it be clearly defined and controvertible, that nothing is outside of the direct control of the lender, and that payment by the guarantor is made in a timely manner.
Makes sense.
So,
but actually, so when something's direct, though, I mean, certainly with UKF, it is the Crown. So you've got a direct claim against the Crown.
Yeah.
But if you're a multilateral, is it sufficient that you have a direct claim against the multilateral, or do you need to have a claim against the shareholders?
interesting. No, it's sufficient to have a direct claim against the multilateral that has issued the guarantee. But what I do see happening recently is that you may have a DFI guarantee supporting a transaction, and another bank comes in as a participant of that transaction and wants to take an assignment of that DFI guarantee. In that situation, you cannot say that the guarantee is direct.
Yes.
For the purpose of that participant.
Yeah.
And so that is something to keep in
Yeah.
mind. So I wanted to look at a couple of these elements and consider them in the context of what we are seeing and the bits of advice that we have to give time and time again. So one of the things that we've looked at in this context of whether or not something is outside the direct control of the financial institution is that the protection that is given by that guarantee will often only be given in relation to transactions which meet certain set of eligibility criteria. Often these are set out in the schedule. They're quite lengthy. And if you contrast this with a different type of credit protection, so a guarantee that is issued by way of an on-demand instrument, whereby you know whether you are on cover because the SBLC or the on-demand instrument has been issued by the relevant guarantor. These are less simple, where you have the eligibility criteria to assess whether or not there is direct control by the bank. Because you have to go almost line by line with all of this eligibility criteria.
And those are the eligibility criteria of the DFI.
The DFI, yeah.
Yeah.
And you need to make sure that they're clear so that the bank understands what is either the obligation or also the quality of that underlying transaction, so that it meets this criteria. That no term is unambiguous, so no term is there's almost like a discrepancy between what something could be. And then what is probably the hardest is that the bank has a process in place to monitor this criteria, because as we know, these transactions are live and they may come in and out from cover.
Yeah, well, you certainly don't want to be out from cover.
And you really don't.
Yeah. I mean, certainly, I mean, English law, when it comes to guarantees issued by UK export finance, for example, English law, general principles of English law are very protective of guarantors. Often, if you see a corporate guarantee, the guarantor will have waived its rights as a guarantor. But certainly when you're dealing with an export credit agency, it will typically preserve the rights that it has as a guarantor.
Yeah. And does that cause any issues for the purposes of CRR?
What it means is that you have to ensure proper compliance with the guarantee. Shouldn't cause a problem from a CRR perspective, because those matters should be within the control of the banks. For example, if it's going to increase the amount lent, or it was going to extend the tenor, or it was going to change what the loan is for. So instead of funding hospitals, they decided to fund roads. Those are all kinds of things that if you did do those things, that is highly likely to result in the guarantee being off cover.
Yeah.
But, I mean, with a corporate facility, you usually put in waivers of those defences, but export credit agencies will not waive those defences. But those kind of things are all within the control of the lenders. So the lenders don't have to increase the amounts, they don't have to extend the tenor, or they don't have to change the purpose.
Yeah. And likewise, I think both in ECA guarantees and in DFI guarantees, you will often have restrictions on amending those terms without the consent of the guarantor.
Yeah.
And so much more than when you're looking at, for example, a corporate guarantee, where you have a little bit more room. Here, each time that any amendment is going to be made or any changes to the transaction, we see the banks going back to the DFIs, to the ECAs. And this is a relationship, especially with the ECAs, that are very long term. So during the life of the whole project, constantly be going back to that entity. The other thing to mention is also that, you know, going back to what a DFI's remit is, you know, the DFIs are looking to support the transaction for the benefit of the obligor, who is often located in the emerging market where they are looking to support development. And so in this context, the DFI will often have certain requirements on that obligor, but then also like policy and social or environmental obligations that obligor needs to comply. And it shouldn't be the case that the bank is then obligated to monitor those requirements, but then also to ensure compliance, because it will not have any control over those elements.
Yes, so I think that's an Isabella clause.
That's right. Well, in the ECA world
is okay. So what's it called in a DFI world?
No.
Okay, yeah.
We just have a side agreement to deal with.
So basically, if in the ECA world, if the exporter and the buyer did something under the export contract, in fact, there may be a breach under there, that doesn't affect the obligations of the buyer to repay under the loan.
Yeah.
But the fact that buyer and the exporter have done something that they shouldn't have done, that doesn't invalidate the cover. Yeah.
Whereas here, what we often see in the DFI space is a side agreement being put in place, often before the guarantee is issued, but where the DFI enters into a separate agreement with that obligor, setting out all of these obligations, ensuring compliance, and then also allowing the DFI to have recourse to that underlying obligor in the event that there's a breach.
Yeah. So in an ECA perspective, you'd have an exporter's undertaking between the exporter and the export credit agency.
Yeah.
So the export credit agency would have recourse to the exporter.
Directly. So let's take a look at this, the timely concept, and the time that is prescribed across a number of these guarantees actually varies quite widely. And as far as I know, the PRA doesn't really have a specific requirement for what timely might mean. It doesn't say it's within 5 days. Or
Yeah,
within
I mean, actually, their original
3 months.
proposal had a very short time period when that was when the consultation came out many years ago, and there was a big pushback on that because there was the whole concept of timely was just far too short, and certainly with export credit agencies, there tends to be a longer time period
Yeah.
for the payment to be made.
And I think that there is now a flexibility that is given to this. So the EBA, I think it just says that it needs to be a determinable period.
Yeah.
So then the length and the circumstances that that period is dependent upon. But then the PRA also has acknowledged that there will be difficulties in setting, I think, this one measurement. But we have seen, I've seen guarantees that have a time limit of, 5 business days or 15 business days during which a payout can come. But I think in the ECA space, you will often see much longer periods.
And the reason for that is to try and remedy the underlying transaction, because if you're working on a project, a hospitals project or a roads project, ideally that project will be completed.
Yeah.
I mean, if there has been, and so there may be time, you need that time to have the discussions to work out how to resolve the problem.
Yeah.
But I suppose the important thing to bear in mind is that, particularly when you're waiting for a sovereign, the credit risk has moved from the original borrower that had a poor rating to a much better credit risk. So although you may have to wait to get paid, you've got a much better credit risk.
You do. You have a much better chance of getting repaid.
Well, I don't think it's so long as you've complied with the guarantee. I mean, I don't think it's the risk of not being paid shouldn't arise.
Yeah. And so what is timely in the ECA context? I think I've seen like even 90.
Yes, 90. So there's a spread, but it depends on the product.
Okay.
But for medium and long-term products, 90 days would not be unusual.
Okay. And I think all of that is to say that the CRR compliance will not be prejudiced by a longer.
Because I think that what you're looking at in timeliness is that if you had a corporate guarantor and you've got problems with the subsidiary, you want to get paid by the parent company very quickly, because what happens to the subsidiary could contaminate the parent, so you want to get paid out quickly. There's something that affects a borrower in Ethiopia, that doesn't affect the credit rating. Whether you have to wait 90 days, that doesn't affect the credit rating of the export credit agency.
Yeah.
But where you've got the risk of contamination from a subsidiary getting into difficulties that could affect the parent, you want to get paid out quickly. You don't want to hang around.
Yeah. Exactly. So I think the next element was what is meant by something being clearly defined and incontrovertible. So the PRA wants basically defines that it incontrovertible means that the wording of the guarantee should be clear and unambiguous. There wouldn't be any scope for dispute or any ability for the guarantor to be released from its obligations. So in this context, I wanted to look at the representation that might be given by the bank, because really a misrepresentation is, under English law, allows for a rescission of the contract. So allows for that guarantor to no longer have to pay under that guarantee. And we often see in these types of guarantees quite wide representations that need to be almost narrowed down in order to meet the eligibility requirement that something is, or that guarantee is incontrovertible. So we often caution the bank when we get involved with both the structuring and then also the negotiating of these guarantees. Our focus is quite heavily on these representations.
I mean, certainly from an ECA perspective, I mean, it was in the past when you looked at guarantees from ECAs, they just weren't very well, or I suppose the drafting was quite old-fashioned. But so when you looked at some of those ECA guarantees, it wasn't clearly drafted. I mean, the drafting was quite old-fashioned and out of date. But I think now, I mean, export credit agencies have invested a lot of time in terms of providing a suite of products in terms of their guarantees that will work from a credit risk mitigation perspective, and ensuring that those guarantees are clearly defined, that they are incontrovertible.
Yeah, but we do still see, I mean, everyone's very recently have seen quite a lot of these guarantees that were put in place back in 2005 and 2015, you know, very long ago, because of course there has been no need to onboard transactions to be covered under these guarantees. And so we are now looking at them with different perspectives, with CRR in mind. And this is where we are identifying a lot of very broadly broad obligations that may not meet this requirement. So it is something to keep in mind. You know, you often have also very wide covenants that there should be a compliance with all applicable laws, for example, and you can't really have the bank know of the extent to which something covered by all applicable laws.
Yes, I mean, certainly I think in terms of point about representations, if taking a step back, if the bank has to make a representation, should look to scale that back so it's the bank team that make a representation. So rather than the bank as a whole, because it may well be a part of the bank knows something that the bank team doesn't know, but another part of the bank does know.
So then we also can look at the extent to which the PRA is expecting the bank to consider the likelihood of like a change in a scenario. So here we're looking at a change in law or the applicability of sanctions. And that has come up quite a bit recently.
Well, I mean, certainly with change in law, there's not much you can do about that.
Exactly. I think
I mean, with sanctions, what you don't want if there's a sanctions in event that the previous anything governed up to the sanctioned event goes off cover.
Exactly. But I think like if we take first whether or not there is a change in law, I think you're right. From our perspective, we would think of it as being almost inconceivable that you would have to allow that guarantor to come off cover.
Well, I mean, it's a legal risk.
But,
I mean, if there's a change in law and so there's off cover,
then there is no cover. You wouldn't be able to force that guarantor also to pay and make a payment that is
but usually how that's addressed in an export credit agency facility, that would become a mandatory prepayment event.
Okay, we've also seen like you said about the ensuring that what has been on cover up to the point where the sanctions occurred, being able to be undercover or be
so that should remain
paid
on
out
cover.
for and remains on cover. I think the other thing that we have seen often I've seen in DFI guarantees is actually allowing that guarantor to refuse to make a payment where on the basis of its election to be governed by certain law that may not apply to it. So it's almost extending its discretion.
But if you're a UK bank, for example, and you have the benefit of a guarantee, you should always be paid out. But presumably, what you're saying is that the DFI wouldn't pay a Russian beneficiary, even though the DFI might not be called by the sanctions.
That's exactly it.
Yeah.
And so you would expect that for that payment to be made to the UK,
but not to Russia
entity, but not to Russia. But often what we see in some DFI guarantees is that the guarantor is looking to not make a payment at all. And so that needs to be addressed. That is often.
Certainly that would be problematic for a UK institution.
Yeah. So I think those were the only elements that I wanted to touch on, almost like things to consider. But I think we were looking.
But as we've seen, I mean, DFIs are popular for banks. I mean, the Export Credit Agency is really very popular.
Very popular. DFIs are growing in popularity for banks. But I think that these types of guarantees take more time to put in place. And like I said, to put all of the processes in place at the bank to monitor.
And are DFIs receptive to changing them if need be?
Very much so, because I think, well, to a certain extent.
Yeah.
But like you said, ECAs have spent quite a long time in updating, say the wording. DFIs are doing exactly the same. They're very conscious of the fact that banks are looking to obtain this CRR benefit, but then also if those transactions are going to be serviced by banks, then this is the tit for tat. Then those guarantees need to also enable the bank to obtain this capital.
Yeah, well, particularly as the driver is development finance. Yeah. I would imagine a lot of situations. So, well, thank you for that. Yeah. And welcome. So yeah, thank you for that, and it's great to have you on board. And as I said, we've worked together closely in the past. Well, one of the things we've been discussing recently is looking horizon scanning, as we term it. And one thing that's come up is CRD 6 that I think has been approved at an EU level and just needs to be published. And then when it's published, there'll be a period over which a period of time before it actually takes effect. But what it is going to do, or sorry, the current position is, if you're a third country institution lending into the EU, the provision of those services is a matter of national law. The EU is looking to put an EU-wide prohibition on the provision of cross-border services into the EU, and that's in relation to core banking services, and core banking services will include lending. And these new provisions, which are expected to come into effect in 2026, will mean that there need to be new capital and liquidity requirements for branches in the EU, enhanced governance and detailed reporting requirements. And oops, I just wanted to go, so actually the reason why this is, and sorry about jumping back and forth, the reason why this is relevant is that when we look back over 2023, ECA activity in Europe was unprecedented. It was 40% of the global ECA market. These are according to figures from TXF. There were 270 transactions. So Europe has been a very important market for the ECAs. And there's going to be a new regime when you're lending into Europe, which is going to impact on the ECAs. So just taking a step back. So what the new regime is looking to do is harmonize treatment across the EU. And the reference here to TCBs, that's third country branches. To date, they've been looked at on a national law basis. Going forward for these core banking services, so deposit taking, lending, giving guarantees, that is going to be subject to CRD 6, which is going to be a much tougher requirement. And so there'll be a requirement for capitalization of branches.
So does that mean that you're going to need a branch?
You're going to need not just a branch, but a capitalized branch, and you can't jurisdiction shop across Europe to find which one has the easiest requirements for setting up a branch. So the final text is expected to be published Q2 of this year. Then there's going to be an implementation period. So these new requirements will go live in 2026. And as we saw from that previous table, a lot of ECA activity in Europe. So there's going to be likely to be an impact here in terms of, for those branches that are providing export credit financing, it could be that the requirements go up in terms of reporting. So that's certainly relatively, it's something that's going to happen.
Yeah.
And it's relatively new, but we'll update our clients going forward on that.
Once we know it has been published.
Yes.
Excellent. Well, definitely I'll watch this space.
Yes. So I don't think we've got any questions that have come up. Oh, there are some Q&A at the top there, so just bear with us.
We have a question about who pays the cost of the guarantee.
Yeah, so that is a very good. So the question is, who pays for the cost of the guarantee? Presume the borrower, and if the bank bears the cost, does it really reduce the cost of borrowing at the end of the day? Well, so certainly with export credit agency financing, it is typically the borrower that will pay the cost. So that can increase the all-in cost of financing. And I know that the OECD consensus is looking at the way premium are paid, but typically the cost, certainly for an export credit agency financing, the cost is paid by the borrower. I mean, one thing that may happen to try is that the borrower could actually seek to try and get the funding for that guarantee elsewhere, so from getting grant funding, which could make the whole financing concessional.
But I think often as well, the cost of the guarantee from a DFI, it is often the guarantee fee, that is called, it is paid by the financial institution.
With the DFI?
With the DFI.
Right.
So a little bit more direct.
Yeah.
How that fee is calculated varies.
Yeah.
And I think the next one is on when we are looking at the relevant jurisdictions for the purpose of that legal opinion, it's how the relevance is determined.
Yeah.
I mean, put simply, you look at the governing law of that guarantee. And from our perspective, that will be why we are approached, is because it's governed by English law.
Yeah.
But then you're also going to be looking at the law of the incorporation of that applies, the applicable law for that financial institution.
Yeah.
And then in terms of the law of the guarantor, well, as we say with DFIs, we are looking at these specialized entities with their own governing laws, and so governing rules. And so we do analyze those governing rules for the purpose of putting together that legal opinion.
Yeah.
But you wouldn't be looking, for example, at the governing law of the underlying transaction, if there are any, for the purpose of providing that legal opinion.
Understood. There's a good question that's come in, that would a bank's own cost of funds requirements change if DFI ECA facility went into default, but then was subject to an agreed restructuring supported by the same guarantee. Now, I think the answer, I mean, the guarantee remains the same. Certainly from an export credit agency's perspective, you've still got a guarantee from UKEF, US Exim Bank.
Yeah, exactly.
So your the benefit you get from that guarantee, even though the underlying facility has been restructured,
Yeah, exactly. I mean, that
should remain as
guarantee rating is still the same because that restructuring doesn't affect that guarantor.
yeah.
What has changed is the underlying transaction that is still on cover, is still guaranteed. The element of restructuring, what you have to keep in mind is what that guarantee, either from the ECA or the DFI, if anything, prescribes in relation to restructuring.
Yeah.
But also the thing like with project finance, you look more at the ability to recover or enabling that project to go ahead and finish.
Yeah. Well, certainly you wouldn't do any restructuring without, from an ECA perspective, without working very closely with the, yeah.
That's fine. Okay.
I think there are a couple more questions that we might just. There are actually quite a few other questions that have come up, which we'll try and, what we'll do is we'll save those, and actually probably best thing to do is actually put a briefing note together.
Yeah, let's do that. I mean, then we can,
because there are quite a few questions coming in, so I think it's actually quite timely.
Yeah.
But we'll certainly follow up. If we haven't answered your questions, apologies. It's not because we're going to ignore them. It's just we're getting quite a few in. There seems to be some themes that, but Daniela and I will address those. We'll put a note together on that.
Yeah.
But Daniela, welcome, and it's been very nice.
Thank you.
Doing this seminar with you.
Thank you.
And to the audience, thank you very much for joining us today. And I know we've got another seminar coming up, or webinar next month.
It's actually going to be Jeff Wynn who will give an update on financing trade assets and who should be controlled. So look out for that in mid-April. I think the date is going to be 25th of April. So look out for it on our website. There'll be a invitation to that.
Excellent. Well, look, thank you all very much for joining us. Welcome again,
Thank you.
Daniela, and we will follow up separately with a note looking at the questions raised. So thank you very much.
Thank you all. Bye-bye.